Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the value of consumer data, my interview with Curinos' Ken Flaherty and Rich Martin on key opportunities for lenders to attract, retain, and grow more profitable customer relationships across both first mortgages and home equity products, and reaction to yesterday's Consumer Price Index report.
Thanks to Ocrolus for sponsoring today's podcast. Ocrolus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights. Ocrolus is empowering underwriters to make timely, confident lending decisions. Whether you need to verify income across complex pay scenarios or review borrower documents with confidence, Ocrolus helps mortgage teams move at the speed of automation with the precision of human oversight. Learn more at ocrolus.com/mortgage.
JPMorgan told fintechs that it will charge for access to its customers' bank information. The fees would bring big bucks to JPMorgan, but eat into the profit margin of any lender or credit reporting agency or verification service. Will this become a trend with other depositories? Lenders and their originators, along with MBS investors, carefully watch trends in income and individuals. The gig economy, driven by on-demand work and services like ride shares and food delivery, is a growing part of the U.S. economy and primarily consists of sole proprietorships tracked by the U.S. Census Bureau's Non-Employer Statistics Program. The top 5 gig-related industries by number of individual proprietors were couriers and messengers, taxi and limousine services, janitorial services, independent artists, writers, performers, and child care services. All have shown notable growth over the last decade. While not all non-employer businesses are part of the gig economy, these industries highlight the increasing prevalence and economic significance of gig-based work. But back to JPMorgan. Some lenders are doing well, at least in the big bank world. JPMorgan reported that mortgage origination volume increased 26% year over year to $13.5 billion. Despite the jump in volume, production income actually fell from $157 million to $151 million. But this was offset by an increase in servicing income. Wells Fargo clocked in at $7.4 billion in the quarter versus $5.3 billion for the second quarter last year. If you couldn't tell, this week brings a whole host of quarterly bank earnings on Wall Street. However, the main headline yesterday was the consumer inflation report, and after 4 months of cooler than predicted numbers, the U.S. Bureau of Labor Statistics reported that U.S. inflation rose 2.7% year over year, faster than May's 2.4% reading. Basically as expected, but still above the Fed's target. However, unlike in previous months, the new data signaled that some companies are starting to pass tariff-related costs on to consumers. For now, predictions remain split. Some see the tariff impact as a temporary shock, while others view it as the beginning of broader inflationary pressures. Consumers have already begun adjusting their behavior, cutting back on discretionary services such as travel and dining, while goods spending seems to have accelerated in anticipation of higher prices. Retailers' earlier stockpiling efforts have temporarily softened the inflationary impact, but as those inventories deplete, price pressures could build again. Given these crosscurrents, the Federal Reserve is likely to rely on continued labor market strength as justification for maintaining its cautious, wait-and-see policy stance for now. For today's interview, I wanted to welcome back to the show Curinos' Ken Flaherty and Rich Martin to talk about key opportunities for lenders to attract, retain, and grow more profitable customer relationships across both first mortgages and home equity products. Ken is manager of home equity at Curinos, and Rich is senior vice president of retail lending. They're both incredibly adept at explaining how Curinos is delivering data insights that lenders can leverage now more than ever. And they both have a great finger on the pulse of what's going on with the mortgage industry from a data perspective.
The overall theme today is market themes that are resonating with your clients. And before we dive in, high level, what are those themes going on out there that we're seeing?
I'll start on the mortgage side, and then Ken, you can obviously speak to what we see in home equity. I mean, I always say with these sorts of questions, right, is perspective is key when we look at themes and kind of where we're at so far this year. I think nothing has changed we are still plagued with a lot of uncertainty out in the marketplace. But if we look at kind of our 30,000 foot view from Curinos, at least the mortgage side, and this will hold true for equity, is we're still doing more volume or capturing more volume than we did this time last year, right? So on a year-over-year basis, mortgage is still up, albeit depending on what channel you're talking about, but let's just focus on retail. We're still up about 3 to 4% this time versus last year. I think that's just something, as you contextualize the market today, if you were to ask people, I think on the front lines, the originator side, people in the back end in the cap markets world, they probably don't feel that, right? And so I think it's just important to look at it of, we are still originating more volume than we did last year. I had said kind of the beginning or going into this year, 25 would be something of a 23 and 24 kind of combined year from a total originations perspective. But I think that's important as we talk to our clients, we're talking to prospects, is the market is growing. We're starting to see it taper off a little bit, and that's just, I think, some of the themes we'll talk about in terms of rates are stubbornly high or elevated. We're not seeing them. We saw some recent decline, but we're still not where we need to be, I think, to get sort of that next big push from the demand side. But I just always like to put that as the backdrop of there are people, and many listeners would agree, like there is opportunity in this marketplace. I think it's knowing, and where people really leverage Curinos and the insights is, where is that growth opportunity, right? Real estate's local, so what's happening in Ken's backyard in Ohio is different than what's happening in my backyard here in terms of Seattle.
Ken, before we dive into some of that, on the home equity side of things, what trends are you seeing out there?
I'll see Rich's first mortgage growth rate and I'll raise him. So last time we talked, Robbie, we were tracking along 15% annualized growth. We're closing in on that 20% number. So we keep churning on home equity. We continue to see the higher velocity and demand from borrowers. So we're nearing in on that 20% growth rate. And I think the interesting piece there is we're now seeing it a larger demand from historically what we would call some of the most rate sensitive borrowers. So those high credit score borrowers. And I think the rate cuts that we got the end of last year were certainly not, at least at this time, in a rising rate environment. So it's taking some of those more rate elastic or rate sensitive borrowers, getting them off the bench, tapping into that equity that they've built for the last several years, staying in that home for longer. So really seeing a really great runway through the first half of 25, and we're certainly seeing that runway continue throughout the rest of this year into next year.
Let's kind of keep ping-ponging it here. Rich, you alluded to it. People that work in the industry don't feel like times are that much better, even if rates are lower and volume is up. You mentioned a good thing there at the end about how companies can leverage Curinos' data and insights. For people that are kind of frustrated that the market hasn't taken off, hope hasn't panned out as a strategy, what are the best ways to leverage a company like Curinos when it comes to using all that stuff that y'all have at your clients' disposal?
I'll give credit to your dad. Rob has said this, I remember at a conference years ago, is you can't manage what you can't measure, right? And I think that's where we look at is their data around understanding outcomes, but they have to be measured outcomes. What I mean by that is what products you're going to market with from a product design perspective. How competitive are your rates, right? I think why people aren't feeling this, and call it green shoot, right, in the marketplace today, or what our data is kind of suggesting or indicating. I think it's more broadly of like, how do you measure this, right? Like there's heightened competition. We know the total, piece of the pie or the total origination size is lower than in the greatest years we had in 20 and 21. We've come off that, but better understand is like, what is that opportunity for me, right? If I'm a president of an IMB or running, head of real estate at a credit union or a bank, what is the opportunity for me? Well, I feel like most of the folks we talk to that maybe are looking to be more data driven, right? Just kind of using the cliche, like what's actionable within this? And I think that's where we at Curinos really help our clients. Ken on the equity side, me and the team on First Mortgage, is there is demand out there, right? It might be pockets of demand. It might be, Ken can talk about this in kind of we've seen more innovation the last couple of years in home equity. It's become a much more crowded space. I think you said it right, Robbie, of mortgage has just been kind of stay the course or now thrive. What is it? Stay in the mix till 26, I think was the latest adage that was out there. Keeps jumping around. But I do think that's right of what's this opportunity for me? And I would put the mortgage mortgage companies in two kind of schools of thought. One, I'm very much still a defensive mindset. Maybe they don't buy into that there's opportunity. Hey, if mortgage rates stay in this mid 6 to 7, we're going to start to see an impact no matter how resilient the consumer is today. The prospects are, we think if we stay elevated for another 5 or 6 months, mortgage demand is going to taper and there's maybe less available demand. And Ken can talk about what that means for home equity. Obviously, it's a little bit different story there. But I think it's honing in on it. Where am I? Am I defensively mindset, which means I just want to preserve what market share I have. And I just want to find, obviously, then it becomes, well, I want to be more profitable, right? We've margin compression is a real thing. It's been a real thing for the last probably 7 or 8 quarters, right? We're starting to see that moderate a little bit. Is how can I be more profitable in terms of when I'm originating today? The other school is buying into this. There is actual demand out there. Are looking to grow is, well, how do I grow? And so I do that through leveraging Curinos data, being more data driven in, I want to make sense of what's going on right now. Who am I competing against? Which if you got all of our credit union clients and banking clients and IMB clients in one room, they would say, well, we don't compete with them. That's no longer the case, right? Because volumes are down to the degree they are. Everyone is competing with one another. They're doing it through different products, they're doing it through different experience, et cetera. But I think that's where having something real time where you can incorporate what we do, the data we have, you're getting a real time read, you're getting daily pricing intelligence, you're getting weekly origination insights. So what was being originated last week? And then on the portfolio side for home equity, how do these assets perform on the books over time? And so I think it's getting people to believe there's opportunity out there, but also we recognize this is a huge paradigm shift to, it's a lot of work, right, to make sense of this. Like there isn't kind of the one smoking gun you'll find every single week. It's discipline, it's rigor. That's where you're going to create these opportunities. But I think it's important of some clients simply just want to preserve what they have. And I think that's, that's certainly one camp. We're going to be on the more opportunistic. We think there's even more opportunity out there, but we understand that this is very much a crawl, walk, run type scenario where to be data driven, right, for a lot of folks is brand new, kind of an entirely new mode of thinking. So long answer, I know, but maybe Ken, you can talk a little bit to some of those kind of key use cases or how folks are leveraging it for home equity.
Yeah, I think I can keep it pretty simple. And back to your point of you can't manage what you can't measure. Thinking about that growth rate, that home equity, the average lender is seeing this year is close to 20%. So not having this data, in any normal year, you look at it and say, Ken, I'm having a 10% growth year. I'm on fire. When I show you that the market, everybody around you is growing at 20%, you're actually losing market share. Then it becomes full circle for you of, I thought 10% was a success. Now I'm actually feeling a little poorly about my performance. Why am I still losing share? Why am I not retaining the same customers at the same clip I had last year? So to Rich's point earlier, to really understand the total value in the market, just how much the market is growing, and specifically just what that total market size look like, that's half of the challenge right there, is really what is my addressable market? What is the momentum? So I can effectively understand, what my growth rate is, what I should be expected to be growing at and retaining my customers, growing my market share, retaining share in both a down and an up market. And then lastly is really understanding, getting your hands around just, how am I losing share? How are other lenders or how are they able to grow at such an expansive rate? Is it through a price strategy? Is it because they have a better fulfillment solution, getting customers to the closing table faster? So really trying to pinpoint exactly what that is and why that is, and to be able to effectively manage that change, to be able to compete better and to be able to grow and retain your share within the market.
I have to tell you both candidly here, I'm getting frustrated with the survive until 25, stay in the mix until 26. It's going to be heaven in 27. I don't know what they'll come up with, but I think we've learned hope isn't a strategy, and I guess that would naturally segue into what are the best practices for leveraging data. for driving data-driven insights. I'm redundant in saying it like that, but how can you get companies to utilize Curinos in the best ways possible? Rich?
Yeah, I'll start, and I think it gives some vantage point here of Ken and I were both former clients for a number of years, but I will say from my own personal experience and then best practices from a client perspective is the first piece of it, I think, is just assimilation. Like you have to get buy-in internally, and that's from a operations perspective, a credit or risk perspective, a production down through treasury and a bank, et cetera, where, CFO business line, et cetera, where everyone understands that even if it's this paradigm shift I was talking about earlier, where, okay, we don't believe the data at the end of the day. I think, that's a piece here too, right? It's like the data's got to be one, repeatable, and I think and then two, scalable. Like you can't just be looking at, if I'm a mortgage originator in 40 states, yeah, I'll have my footprint or kind of flagship markets, but I need something that's an enterprise view. So I'm not chasing, I say mortgage pricing forever ago or years ago felt like whack-a-mole. This week it's Robbie at his new credit union. Next week it's this new IMB. Next week it's this. You've got to assimilate it in though, where your key stakeholders, cross-functional teams are all using this as your single source. You can still get field intel. I would always say, like, I'm not going to, dissuade my originators on the front lines. That's helpful, but again, that's going to be transactional, one scenario or single scenario. That's not telling me how's the enterprise performing. But where we've seen it is if you don't have that buy-in across the organization, you're just not going to have success. Certainly, even near term, but more long-term success. I think that's probably one of the things we're most proud about at Curinos is, even through the grind of 22, 23, 24, and some would argue into 25, we've averaged a high 80s, low 90s renewal rate, right? It's not something you're going to spend the time assimilating into it, and then a year later saying, "Hey, we simply don't see the value here." But I think it goes with assimilation is the first step of it, and then I think being thoughtful of, let's assume you're a larger originator, you're not a single state originator, that's going to be a little bit easier. That assimilation process is, how do I start scaling this to the footprint that I have, and then really honing in on, I've only got 30 minutes every, Robbie, I'm presenting to you as the president of the company. I've got 30 minutes every week with you. Like, how do I sift through this data, understand what are the three most important metrics for my mortgage business? What are the three most important metrics for my home equity business? And I think that's where we've got a dedicated client success team where we work with our clients on, okay, this is what you want to surface up weekly. You can always spend, as you know, like the analysis paralysis, you could spend hours. I always joke with our clients, if you just had someone that would spend 4 hours a day in our data and our solutions, like that's what great looks like. It's just not realistic. But I think that's, starting at that point of assimilation, expanding it out, scaling it to the enterprise, and then finding what are those repeatable metrics every week, every month that I want to see. To Ken's earlier point of, I don't know if I'm up 15% in the month of June. Is that good? Is that bad? Is that mediocre? And that's where our data helps offer that objective view in there. And again, you're measuring it on a consistent basis over time.
Ken, anything to add from the home equity side?
Yeah, back to your original question of, how to effectively leverage data for meaningful insights and strategic decision making. I've always looked at it as the strength of our data is looking at it as a point in time. How am I doing today? But also understanding where you've been to better understand where you're going. And what I mean by that is, if I work with a client and I look at a single data point and say, here's where you are versus the market, that gives me good intelligence. That doesn't give me much context as, am I getting better or am I getting worse? So the impact of Curinos's data, it's timely. We get it every single week from a benchmark of lenders. But number two, the historical nature. So being able to look backwards through present to understand where I've been, where I'm going, to really understand how did I get here. And that really helps a lot of lenders for that more strategic decision making of, how is the market shifting around me? What changes have I made? What changes has the market made? What changes in demand are we seeing from kind of borrower demand to effectively be able to deliver into my go-to market strategy to ensure that my strategy isn't based upon what worked 3 years ago. It's evolving and changing and ensuring that my strategy is shifting based upon the demands in the market today and where it's trending.
And that's probably a good. Oh, go ahead, Rich.
Just add, I think that last statement is what's key is it may not mirror my strategy, but it gives me the context to either defend my strategy or to look to augment. And I think that's where we have clients in, well, we made a deliberate choice to do X, Y, Z, and the market moved counter. I think any executive would say, okay, line of business head, why did we decide to do that? And that could be someone that's an existing client, prospect client, never even heard of us. Is I think that Ken's right on that. Is that North Star in terms of strategy? And then again, you don't want to be looking 3, 4, or 5 months in the rear view. You want to make sure that you're proactive in what you're looking at. And where I think a lot of clients benefit from our data is I can go in to say, yes, this was the right call, whether it's a pivot in strategy or a double down to say, we simply, can't do anything different. Maybe there are other factors to consider, variables like our tech stack's 10 years old or something, right? Something from that end where no matter what you say, Curinos, we really aren't in a place to, but we can use Curinos data to support that capital investment into new proprietary technology, as the widgets are made, different components are facet to it. But I think Ken's point is a really important one on you want to make sure you understand your strategy in the context of the market and what your competitors, or maybe what you don't view as your competitors, at least direct competitors, what they're doing to seize that market opportunity or outperform. Like how good is good in this market? And that's a lot of what the data.
That's a good place to leave. I was going to ask for things people should be thinking about that maybe they're not, but I think that was such a comprehensive answer that probably covered it. I appreciate the time, gentlemen. It's always a pleasure speaking with both you individually. Twice as nice doing it together. So thank you.
Thanks, Robbie.
Thanks, Robbie.
Treasury yields resumed their climb amid growing expectations that the Federal Reserve will maintain its current policy stance after yesterday's CPI report, with short-term yields, those most sensitive to Fed decisions, leading the move higher. In fact, yields across the curve reached their highest levels in several weeks, and the 30-year bond briefly touched the 5% mark for the first time since early June. Financial markets reacted to the shifting outlook with a modest sell-off in treasuries, wider mortgage spreads, and diminished hopes for rate cuts in the near term. As most of us are aware, political uncertainty surrounding the Fed is compounding the aforementioned monetary policy challenges. President Trump has renewed his criticism of Fed Chair Powell and hinted at a leadership change, feeding speculation that markets may soon see an earlier than expected shift at the helm of the most influential central bank in the world. Even without a formal transition, the prospect of a new, or shadow, Fed chair with a more dovish stance could influence expectations and market behavior. Much is dependent on the outcome of tariffs targeting the European Union. Today's economic calendar kicked off with mortgage applications decreasing 10% from 1 week earlier. According to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending July 11th. After yesterday's CPI report, June PPI was released this morning, flat month over month and flat on the core rate, up 2.3% year over year. Expectations were for a month over month increase of 0.3% and 2.5% year over year versus 2.6% previously. Later today brings industrial production and capacity utilization for June, Treasury conducting a buyback in 1 to 7.5 year tips for up to $500 million, and a full slate of Fed speakers ahead of next week's blackout period before the July 29th and 30th FOMC meeting. Bank earnings also continue, with Bank of America, Morgan Stanley, and Goldman Sachs all reporting before the open. We begin the day with agency MBS prices slightly improved from Tuesday's close, the 2-year yielding 3.92, and the 10-year yielding 4.45 after closing yesterday at 4.49%. Let's wrap up with a joke and some housekeeping. I took my car to the mechanic last week, and unfortunately he couldn't repair my brakes, but he told me in lieu of that he made my horn louder.
Thanks again to Oculus for sponsoring today's podcast. Oculus is transforming the mortgage industry with AI-powered data and analytics, featuring cutting-edge tools for automated indexing, income analysis, and discrepancy insights that empower underwriters to make timely, confident lending decisions. To learn more, visit oculus.com.